What's up? Today we'll be talking about some of the best ETFs to buy on the dip. The first thing I'll say, timing the market and predicting short-term moves in the market is incredibly difficult, if not nearly impossible. However, when the market does go down, while we may not know for sure if it will continue to fall, we can at least recognize that stock prices are cheaper than they were and then react accordingly. This, in combination with keeping a long-term outlook, is typically a recipe for success. And because we are talking about long-term holdings, I tried to pick low-cost ETFs for this list, so we're not losing too much money to fees over the years. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, feel free to lurk down below and check out the links in the description. You can get free stocks, free crypto, also a free $30 to sign up with Rakuten, a site where you can earn cash back on everyday purchases. Without further ado, let's get started. So let's talk a little bit about buying the dip in general. Buying the dip is, of course, when stock prices go down, an investor buys in at cheaper levels and then reaps the rewards. This is pretty easy in a bull market when the overall trend is upwards. In this environment, an investor gets the satisfaction of seeing the rewards of buying the dip pretty quickly. Prices go down, investors flood in to buy the dip, and then the bull market continues upwards. However, in a bear market, it's not so simple. Sometimes an investor buys a dip and then the dip just keeps on dipping. In this case, it takes tremendous patience. We've been pretty spoiled in the market over the last decade. We have witnessed a 10-year bull market. After all, 8 out of 10 years the market is up. However, that other 20% of the time is what we don't like to think about. In all reality, the market can trade sideways or trend downwards for years. For that reason, when I go to buy the dip, I am careful to only buy ETFs that I am comfortable holding for years and that I am comfortable holding through a bear market. We tend to not think about risk in a bull market. Then in the bear market, we find out just how much risk we were taking. Proper portfolio allocation is best done when the market is up as opposed to down. The last thing you want is to find yourself holding a portfolio that you are not comfortable with during a bear market. This increases the risk of selling at the worst possible time. I also like to keep my ETF fees cheap. A high expense ratio doesn't seem like a big deal in a bull market when you're making money, but high expense ratio is just an extra slap in the face in a bear market when you're already losing money as it is. But in either case, you're still losing capital and ultimately the opportunity cost of that capital compounding in the market for years. So it really adds up. So alright, let's get into the ETFs. But first, I've done more detailed videos on almost all of these ETFs on today's list. So check them out in the description if you are interested. First, let's get the broad market ETFs out of the way first, and then we can look to some other options further out on the risk curve to potentially see juicier dips. VOO, the Vanguard S&P 500 ETF, and VTI, the Vanguard Total US Market ETF. Because these ETFs are mostly large cap and also broadly diversified, we typically see less volatility in these ETFs, so potentially less juicy dips to buy, but ultimately safer options. I put the word safe in air quotes because all investing carries some risk, but the broad US market has recovered from every decline in history and is up 96% of the time over a 10-year period. These ETFs are for those who don't believe in trying to pick sectors or trying to pick between growth or value or anything like that. Just own the broad market, hang on to it, and don't stress about it. They don't call it VTI and chill for nothing. Additionally, these ETFs are dirt cheap, only charging 3 basis points annually. VOO holds the 500 largest US companies. VTI holds those same large caps in addition to some mid and small cap names. So with 4,000 total holdings, VTI is more diversified, but these ETFs overlap 84% by weight and thus perform very similarly. Granted, VTI is usually slightly more volatile because of the mid and small cap names. So let's move a bit further out onto the risk curve for those that like to focus on tech and growth. Granted, the broad market already has a lot of tech in it. Growth stocks are companies that are considered to have the potential to outperform the overall market over time because of their future potential. They are generally seen as riskier than value stocks, because while value stocks are typically trading at or below fair value, growth stocks often have future growth priced into their valuation, so if something doesn't go according to plan, or if the broader macro environment experiences a crisis, they can really swing to the downside. During market downturns, the riskiest assets tend to sell off the most. Growth tends to outperform value in a bull market, but value tends to outperform growth during bear market cycles. So we can potentially see some more volatility in growth stocks and thus potentially some juicier dips to buy when things do go south. So let's look at VUG, the Vanguard Growth ETF. This is a cheap, mostly large cap, and well-diversified basket of growth stocks. This ETF only charges 4 basis points and has around 270 holdings. This ETF is a great way to get low-cost exposure to some of the best growth names. For those who like the growth vibes of VUG but maybe want a little more concentration in tech and innovation, we can look at QQQ, which tracks the NASDAQ 100 index, the top 100 largest non-financial companies listed on the NASDAQ exchange. But there is also QQQM, which tracks the same index as QQQ but only charges 15 basis points, instead of the 20 basis points that QQQ charges. VUG and QQQ overlap 64% by weight, so I can see why some people would pick between one or the other. I can see why people would pick VUG. It's cheaper, it has more holdings, and is more diversified. But I can see why people would choose QQQ, as it has historically outperformed VUG. I can also see why people would just own both. For those that want even more tech exposure, we can look at tech-specific ETFs such as VGT and FTEC. VGT is the Vanguard Information Technology ETF. FTEC is the Fidelity Information Technology ETF. These ETFs track the same index and thus perform very similarly, but the Fidelity ETF only charges 8 basis points instead of the 10 basis points that the Vanguard ETF charges. Keep in mind that a lot of the companies that we think of as tech companies are technically not classified as tech companies and therefore do not end up in these ETFs. For instance, Amazon and Tesla are technically consumer discretionary. Facebook and Google are communication services. All these names are left out of these tech ETFs. Oh my gosh!
To get set up on this device, log in through the Google Home app.
Facebook and Google are communication services. All these names are left out of the tech ETFs. Also, VGT and FTEC are also nearly 40% Microsoft and Apple. So keep in mind that the performance of these ETFs will greatly depend on the performance of those two tech giants. For our next ETF, to potentially buy on the dip, let's look at something a little different. All the above ETFs are mostly large cap focused, but in general, we tend to see the mid and small cap names get hit harder during a downturn, and thus a downturn could potentially be a good entry point. So while QQQ tracks the 100 largest non-financial companies listed on the NASDAQ exchange, QQQJ tracks the next 100, so 100 to 200. As a result, it is largely a mid-cap fund. And like the NASDAQ 100, it is very tech, growth, and innovation focused. As you can see, QQQJ has a large concentration of software, semiconductor, biotechnology, and technology hardware companies. I'd say the expense ratio is pretty cheap for what you get, 15 basis points. Let's pick a semiconductor ETF for this list. A semiconductor is a material that conducts electricity more than an insulator, but less than a pure conductor. Semiconductors can be found in thousands of products such as computers, smartphones, appliances, gaming hardware, and medical equipment. The semiconductor industry has been so strong over the last decade as demand for semiconductors has been strong and increasing. The valuation of these semiconductor companies is what keeps many investors on the sidelines, so a drop in the market can be the perfect time to gain exposure. Invesco's SOXQ, at only 19 basis points, is currently the cheapest semiconductor ETF on the market. That's about as good of a price as you can get for a specialty ETF. It's a relatively new ETF, but we can look at SOX to judge long-term performance, as the two overlap 92% by weight. Keep in mind that SOXQ only has 30 holdings, so it's very much a concentrated ETF. Because it is narrowly focused on a niche section of the economy, it can be seen as a bit riskier. Now, we mentioned that we generally see more volatility from small caps and growth stocks. So where can we find a small cap growth ETF? Again, we kind of got close to this with QQQJ, but that ETF is still mostly mid-cap. VBK is the Vanguard Small Cap Growth ETF. This ETF is broadly diversified across small cap growth with around 750 holdings for the low price of 7 basis points. While this ETF has plenty of tech vibes with software, semiconductors, and biotechnology, it also has a notable amount of exposure to real estate investment trusts. When we look at this graph, we can see the kind of volatility that we would expect from this ETF. So what are my thoughts on these ETFs and buying the dip in general? For the most part, I just dollar cost average. Studies show that time in the market beats timing the market. Trying to time a market dip is not only challenging, but sometimes it never comes and you end up on the sidelines during a market rally. I don't typically keep a ton of cash on the sidelines, but when we do see big discounts in the market, I will scrape up some additional money to invest. But for the most part, if the dip turns into a bear market and we see some real discounts, there will be plenty of time to buy the dip just by dollar cost averaging. As far as the ETFs on today's list, I like all of them and own most of them. The key thing being that all these ETFs are cheap, none of them are over 20 basis points. After all, we don't know how they'll perform, but we do know what they will cost. So sometimes we gotta focus on what we can control. I keep most of my portfolio in the broad market as a foundation, and from there, I slowly extend myself further out on the risk curve with smaller and smaller amounts of money. Mainly more concentration in tech and growth ETFs, then a few individual stocks and cryptos. But no matter what happens with those, I always have the broad market to fall back on, because risk is not just what you are buying, but also how much of it that you're buying in relation to the overall portfolio. But if you found any of this helpful, consider hitting the like button and subscribe for more content like this. Again, also consider checking out the links down below. Currently done, you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, $50 with Bitcoin with Celsius, where you can earn interest on your crypto holdings, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and I'll see you in the next video.